All right, welcome to this explainer. Today we're totally demystifying the S&P 500, breaking down exactly what it is, how it works behind the scenes, and most importantly, how you can actually start investing in it today. It's widely considered the absolute gold standard of investing, but to really harness its power, we need to understand the mechanics that make it tick.
So here's our roadmap for today. We're going to look inside the S&P 500, check out the strict entry criteria, play the weighting game, explain equal weighting, figure out how to choose your ETF, and then get you ready to start your investment journey. Let's get into it.
Section 1. Inside the S&P 500.
You literally hear this term thrown around on the financial news every single day, right? But we really have to ask, what exactly is it? And more importantly, what does it actually mean for you as an investor? Is it just some random list of stocks? Or is there, something more under the hood? Well, simply put, the S&P 500 is a stock market index that tracks the performance of 500 of the largest U.S. public companies. It captures roughly 80% of the entire U.S. stock market's value. Basically, think of it like this. You're buying a tiny fractional piece of Apple, Microsoft, Amazon, and 497 other top American heavyweights with just one single purchase. You're essentially buying a cross-section of the entire American economy. Now, what is truly staggering here is the sheer scale we're talking about. Look at this. As of August 2026, these companies hold a combined market capitalization of over $70.3 trillion. Trillion, with a T. The median size of a company in this group is around $41 billion. This is absolutely the heavyweight class of the global economy, just bundled together into one single trackable number. Section 2. The strict entry criteria. Now, a company doesn't just get into this club by being big. There are some serious gatekeepers here. To even be considered, a company needs a U.S. headquarters, a massive unadjusted market cap of at least $8.2 billion, and highly liquid trading volume. But the really crucial hurdle, look at that third bullet point. A company has to prove it has positive earnings in the most recent quarter, plus the past 4 quarters combined. So they have to actually be highly profitable and liquid to earn their spot. That gives you, the investor, a fantastic built-in layer of quality control. And honestly, this right here brilliantly illustrates why this index is so universally trusted. It's not just cherry-picked by a bunch of guys in suits trying to guess the next big trend. No. It's a ruthless, repeatable algorithm that just naturally weeds out the losers. By minimizing fickle chance and incompetence, it really reflects the economy's ideal potential. If a company drops the ball and its market cap shrinks, boom, it gets kicked out and replaced by a new rising star. It's a totally self-cleansing mechanism.
Section 3. The weighting game.
Okay, let's talk about the math behind the index, specifically capitalization weighting. What does that mean? It simply means that the bigger the company, the more influence it has on the daily movement of the entire index. So a massive multi-trillion-dollar company is going to dictate the direction of the index way, way more than the 500th company at the bottom of the list.
And because of that cap weighting, look at how the pie gets sliced up. Information technology eats up over a third of the index at 37.4%, which, makes total sense and explains exactly why tech giants like Apple and Microsoft so heavily sway the broader market. When you add in communication services at nearly 10%, you quickly realize that a traditional S&P 500 investment is actually heavily concentrated in the tech sector.
Section 4. Equal weighting explained. But hey, what if you don't want your entire portfolio dominated by just a handful of massive tech stocks? Well, there's a really interesting alternative approach called the Equal Weight Index, or EWI. In this version, the absolute smallest company in the 500 has the exact same impact as the absolute largest. Every single company gets an identical weight when the index is rebalanced. This gives you a much wider, more balanced exposure across all sectors, kind of leaning your investment more towards smaller company sizes and value stocks rather than just surfing the momentum of those mega giants.
And get this, surprisingly, history shows that equal weighting has actually outperformed the traditional cap-weighted index over a 20-year period. Why? Because it gives those smaller, value-driven stocks a lot more room to run. Over 2 decades, the EWI delivered an 11.50% annualized return compared to 9.99% for the standard index. To put that into perspective, 99% of active large-cap fund managers couldn't even beat the EWI over that same time frame. Crazy, right? Section 5. Choosing your ETF. Now that we've got the theory down, let's talk execution. And you really don't just have to take my word for it.
Even the greatest investors of all time totally agree that passive, low-cost index funds are the smartest way for the average person to build long-term wealth. I mean, Warren Buffett himself has repeatedly recommended low-cost S&P 500 index funds. He even literally instructed his estate to put 90% of his wife's inheritance into one. If it's good enough for Buffett, it's definitely good enough for us.
So let's look at this showdown between the top 4 S&P 500 ETFs for 2026. Keep in mind, they all track the exact same 500 companies. The real battle here is fought in their underlying fees, or what we call expense ratios. You've got Vanguard's VOO and BlackRock's IVV, both massive, reliable, and super cheap at 0.03%. Then you have the original SPY, which is great for active traders who need that intense liquidity, but it charges a slightly higher 0.0945%. And finally, there's SPYM, which is the absolute lowest cost option, undercutting the whole pack at just 0.02%.
Now you might be wondering, why on earth are we stressing over fractions of a single percentage point? Well, because of this number right here, $15,000. That is the shocking amount of lost returns over 30 years on a $100,000 investment simply by choosing the slightly higher 0.0945% fee of SPY instead of the rock-bottom 0.02% fee of SPYM. It's wild. Compound interest is an incredible force, and keeping your fees as close to absolute zero as possible is actually one of the only factors you can directly control in investing.
Section 6. Start your investment journey.
We've gone from the big macro concepts down to the micro details, and now it is time for action. And the best part, you do not need to be wealthy to start. By grabbing fractional shares and automating your deposits, you can literally turn abstract market theories into real compounding wealth. Step 1, just pick a zero-commission broker like SoFi, Schwab, or eToro. Step 2, start small. Even $1 to $5 in fractional shares works. Step 3, automate it with dollar cost averaging so you're buying consistently every month no matter what the market is doing. And Step 4, pick just one of those ETFs we talked about and stick with it for the long haul.
They always say the best time to start investing was 20 years ago. But are you ready to make today the second best time? Look, the math is crystal clear, and the tools are cheaper and more accessible than they have ever been. So the only question left is, when are you going to take that first step? Consistency and low costs matter so much more than perfectly timing the market. The S&P 500 has proven itself over a century of hard data. Are you ready to finally let it go to work for you?